Hey there, everyone. Happy Good Friday. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. It's Friday, March 29th. We're going to take this holiday Friday to focus on the mailbag. We've had so many great questions from you guys over the last couple weeks. Today, we're going to be featuring some of the questions we've received here in the last week from all of you. As a reminder, questions are always welcome. The mailbag is always open. Email us your questions at thefinalbar@stockcharts.com or here on YouTube. Just drop a comment below the video that you're watching. We've got some great questions that we've received here on technical indicators, on particular stocks, particular tickers that you have questions on, different ways of thinking about managing potential return versus potential risk. So I think some really good questions that will address probably some of the questions you've had in your mind as you've been trying to navigate these markets here as we wrap up Q1. With that in mind, let's get to question number one. Dave, what tells you that a stock is in an early stage versus a late stage breakout? And I made a comment on our March 6th show a couple weeks ago. We talked about scanning for stocks making new 3-month highs, and it is something that I do every week. Actually, earlier this week, I just wrote a note for my Market Misbehavior Premium members where I focused on stocks making new 3-month highs. That's always a good working list that I start with. And if you've listened to the monthly exercise that Grayson Rosa and I do from over in our interview set, we talk about top charts to watch every month, and we often use scans for stocks making new highs and new lows as a way of filtering down to some actionable ideas. So Grayson's shows that he does on Stockcharts TV, he focuses on his version of how to do this. I'll show you how I do it. And I would say there's two general ways that you can think about using our scanning engine. And I've heard people have success with both. Option number one is cast a very wide net and then sort of take a good list and then filter it down with other tools. And that's usually what I do. The other option is to make a very specific scan, right? So for example, stocks with an RSI above 40 for the last 8 weeks. Pullback screens where you say stocks using, having a particular, trend over the last month or the last 12 months, and then a different trend over the last 1 month. And you can get very, very particular. I actually keep mine very, very simple. My goal with scans is to just give you a list of things to start to work with, but then I'm always going to want to go through the charts manually. And that just is how my process has evolved. I like having a group of ideas and then filtering them down more manually and actually going through the charts to see the patterns that I think are most meaningful. So the way that I look for that, those 3-month highs and 3-month lows is using our scanning engine, and it's this particular line 3 that you see on here that's really the juice of it, which just says basically this weekly close, the current week, is greater than last week's maximum close for the last 13 weeks. So basically today, we are at the highest close than we've been for the last 13 weekly closes. And all that means is we're higher than we've been for the last 3 months. And that's essentially what that argument is doing. Now, if I run that scan right now, you're going to find that on a week like this, when a lot of things are in primary uptrend, just like the market, right? The S&P and the NASDAQ are making new highs. A lot of stocks are as well. So, grouping this sort of, list by sector, you'll find that there are a bunch of things on here. Now, there are things like GM, which arguably have been in uptrends for quite some time, right? GM is just not new onto the 3-month new highs list. It actually first came up on my new 3-month highs list back here when we gapped higher in November, and then right after the Thanksgiving holiday, we started making higher highs than the last 3 months, and it starts popping up on my screen. But you can see that months later, we've continued to go further and further. So what I usually do is take this list, save it into a chart list, and then I start flipping through the charts. And what I like to do is get to the results. And here we're looking at just a summary view. So a couple things you can do, right? You can sort by percent change. You could sort by, let's see, SMA 200. You could say, show me stocks that are close to their 200-day moving average, which means they're probably not too extended, or you can just go through it manually. So I kind of went quickly through those results. What I did was I did the scan results, I put it into a chart list, and then over here there's this button called columns, and we have a bunch of columns to help you kind of filter a list even further. And things that I like to use would be like the ADX line, which tells you the strength of the trend. You could do this field called SMA 200. What that basically does is it sorts it based on this red or green number, which is how far the price is from its 200-day moving average. So something like MicroStrategy, you can see on the little preview chart, has gone vertical, right? So it's extended very much so. It's actually 250% above its 200-day moving average. But if I go down here and maybe sort on descending order, I'll find things like Hormel Foods, which is not very extended from its 200-day moving average. As a matter of fact, stocks like this are actually just getting above its 200-day moving average. So if I'm looking for stocks that are just early on in their breakouts, that's the kind of field that I would look at. I would scan for stocks making new 3-month highs, and then use fields like RSI, which would tell you something that's maybe not as overbought. I would use something like percent from their 200-day to find things that are a little closer to their 200-day moving average. That will help me find names like this that are maybe early on in a breakout, as opposed to a MicroStrategy or NVDA or one of those names that have just been long and strong for so long. That's how I would use and think about anything that's to a new 3-month high is breaking out from something, and then use other indicators to try to refine that list a little bit further. Great question, by the way, and thanks for asking about that. Question number 2. TSX, the Toronto benchmark, is on the dashboard, but you never really talk about it. Does it serve a purpose? And I quoted you directly from your question. I appreciate that so much, and I love that. And apologies to our Canadian friends from the northern parts of the continent here for hating on your benchmark, and we don't mean to do so. The TSX is indeed in the middle, and you'll notice if you watch the show, I often every day bring up the market overview, and then I gloss right over the TSX, and that is intentional, right? I would say 2 things. Number 1, I'm based in the U.S., and so I'm often coming with my own sort of biases, what they call a home bias, which is you often invest to things closer to your geographical location. That's actually true within the United States. So if you're in the Pacific Northwest, you tend to think about things like Amazon and Microsoft and Starbucks and Boeing because they are local companies. And whether or not you realize it or not, you just hear about them more often. And so that is a documented behavioral bias called home bias. I don't think that's as much of what's going on here, and it's more about the relative importance. What you have to remember is, in terms of market cap, in terms of the capitalization of the markets, the U.S. dwarfs Canada by far, and it's not even close. Right? U.S. is the largest financial market globally, and by orders of magnitude, versus Europe and developed Asia and Canada and other parts of the markets. That's number 1. Is we're focusing on where the bulk of assets are actually traded. The other thing is, and I would say, when we see a rotation in leadership, you'll probably hear me talking about the Canadian markets a little more often. When you think about the S&P 500, right, it's based, the biggest weight is technology, right, and then other sectors beyond that. When you look at the Canadian markets, the number 1 sector, I would say, is probably financials, and I would guess it's probably a third of the market. After that, it's going to be things like industrials and certainly energy, maybe some basic materials would probably be in there as well. And so it's basically the sectors that have been leading so much in the last 6 months and really in the last couple of years have been things like technology and communication services and consumer discretionary in the U.S. Those are just much bigger weights in the U.S. than they are in Canada. Canada is much more geared towards value sectors. So I'm not really paying as much attention to the Canadian markets because the stuff that's been really dominating has been more things that are heavily weighted in the U.S., like technology. The last thing I will tell you, the reason why I haven't paid as much attention to Canada is because of this line right here. This is the EWC, which is the iShares MSCI Canada ETF. So it's a Canadian ETF, but denominated in U.S. dollars, right? It's EWC is the ticker. And then I'm doing that ratio relative to the SPY. And just the relative strength of Canada versus the U.S. has been consistently lower. So even though the Canadian markets have been going up, and certainly the EWC is breaking out, which is encouraging, it's just not doing nearly as well as the U.S. markets. And so again, as a U.S.-based investor, I'm focusing much more on the U.S. markets. Talking with some technical analysts in Canada, most of them that I know, like Greg Schnell, who else have I had on the show? Javed Mirza, who was at Canaccord Genuity for years. They tend to focus on the U.S. markets primarily as well, because that's where the market cap is, and so that's where we're going to be focused. You will hear me talk about Canada more as those other sectors start to do better. I think we might be at that point, as we've talked about, where financials, industrials, energy, materials are starting to do better on a relative basis. So maybe we'll shout out to the TSX a little more often, but not as widely followed as the U.S. benchmarks I tend to quote. Next question, what do you think about using the CCI? That's the Commodity Channel Index. and using the buy signal in our scanning engine and filtering for scooter rankings in the 75 to 85 range. That is a really thoughtful question, Ken, and thanks for sending that in. You know, the commodity channel index, if you're not familiar with it, was created by a technical, I would probably just call him a strategist, named Donald Lambert. And this came out in the early 1980s, so sort of in that same era, what I call the golden age of technical indicators. Wells Wilder created a bunch of indicators, which we use often, like RSI and the ADX line. The commodity channel index kind of came out of that same era. And if you're wondering why, this is really the beginning of the digitalization of price data, and where technical analysis came less about manual charting and more about actually using computers. This was early days, and really where you found you could actually do some statistical analysis and have some help, right? Have a computer actually help you start to do it. But these were still manually done at the time. You're referring to our predefined scans, I think. So if you look at the charts and tools portion of our website, in the right column, you want to come down here to where it says predefined scans. So our scanning engine is really powerful, and if you're a Stockcharts member, which hopefully most of you are and you all should be, you have the ability to create some pretty cool scans to identify ideas and just find stocks and ETFs with particular characteristics. We have a series of predefined scans. These are just commonly used arguments that we think are pretty good starting points, and I would think of them as starting points, by the way. I don't think these are final arguments. This is sort of the initial discussion, right? New CCI buy signals. If you click on that, it's telling you 240 stocks actually fit that criteria on the New York Stock Exchange. If you click on Edit Scan Criteria, you can actually see what this argument is. And most of these just have one particular line, which is giving you the scan. What I would do is hit Save As and then start to add criteria to make this more and more meaningful, right? So this is a pretty broad list of stocks, making a more meaningful, more special list that's going to be relevant for what you're doing. But this right here, sort of the back half of this, is really what's making the scan do what it does. Basically says today's CCI using the last 20 days is over 100. Last 20 days is over 100. Yesterday and 2 days ago, they were less than 100. So basically, in the last couple days, we went from below 100 to above 100. And that's kind of the general idea that Don Lambert came up with when he was creating the indicator. I'm bringing up Medtronic, which I ran the scan earlier today just to prepare for the show, and this came up on the scan. So I'll show you what the scan is actually doing. So I'm going to create a chart just with the commodity channel index. That should be pretty good. Here we go. So you can see it spiked above 100. So the point of the scan is, a couple days ago, it's below 100, and then it started to go above 100. Now I'm going to take the little inspect crosshairs just to highlight times when the indicator was below 100 and then just crossed above. And you will see it often is early on in a new expansion. This one, not really that strong. We went higher a little bit, but not too much. Here we broke above 100. You can see we went higher another couple weeks. Here we were pretty low and then broke above 100. So we see it's often the beginning of these nice upswings. And that's what Donald Lambert had in mind when he was looking for these sort of breakouts. It's basically when the price has been consolidating or price action has been weaker, and all of a sudden the momentum turns very, very positive in a short period of time. And he found that when the commodity channel index broke above the 100 level, that was often the beginning of a nice upswing. And so you could actually play that upswing. So what the chart is telling you today as we spike above 100 is that Medtronic is showing a similar condition to some of these previous upswings. Not at the end of the move. It's not like RSI becoming overbought and you want to start fading that. This is often, just the beginning of a move, and so we're getting that particular sign right there. Now you're combining it with the scooter rankings, which is saying the large cap or whatever scooter ranking in the 75 to 85 range means you're basically looking at things in the top 25%, but not the really overextended stuff. Things that are just maybe earlier on in their moves, and the CCI buy signal means it's probably pulled back a little bit, and then it started to break out as Donald Lambert came up with in the early 80s. Thumbs up on that combination. I think you're looking for strong trends that have recently pulled back and are just starting to emerge. I could see stocks that have pulled back to like a 200-day moving average and popping out would come up on that screen. I think that's a really good starting point. By the way, if you want to learn more, I sort of glossed over the CCI indicator and what it is. This is where our Chart School is a fantastic free resource. If you click on Chart School at the top and just type the keyword CCI or Commodity Channel Index, you'll get to this article which explains the indicator, shows the calculation, shows some really good examples about what Lambert had in mind when he created the indicator, and what sort of signals we're trying to find in that predefined scan. Thanks so much for asking about the Commodity Channel Index. Next question, for Gartner Group, which is ticker IT, buy the breakout or fade the divergence? What say you, Dave Keller? So here's what I would say. Number one, obviously, no, this is not a recommendation, just sort of looking at the chart and applying the best practices of technical analysis, giving a sense of what's what. This is I think a great chart that represents what a lot of charts look like right now, which is the trends have been strong, right? So we're making higher highs and higher lows. The challenge is we're showing a bearish divergence, and IBM looks a lot like this. The Qs look a lot like this. The S&P looks kind of like this. A lot of charts do, and I think this is the conflicting technical evidence that we have right now. Strong trends, but bearish divergences. And one of those is gonna fold, right? Either the strong trend is exhausted because the divergences recognize some momentum weakness that we're not seeing in price, or this short-term momentum weakness rights itself, and you start to see a breakout on stronger and stronger momentum. I can't tell you which of those is going to play out, but generally speaking, I assume that a trend is going to continue until it doesn't anymore. What's interesting in particular about the chart of IT, which is Gartner Group, is the fact that we hit resistance in December. That's right around 470. We hit that resistance again in January, right around 470, and then we've tested this again a little bit. I'm going to zoom into the last 6 months just so we can see this in a little greater detail. So here's that point I was highlighting, but we've zoomed in a little. Here's that resistance in December. Here's that same resistance. Look at the number of times we hit 470 and did not break out. And then look at how that changed here in the last 6 weeks, right? All of a sudden something's different in early March as we start to make headway above there. And then finally, second, third week in March, we've actually pushed above there. And now 470 is probably serving as a bit of a support level. And that's kind of what I would probably assume here, right? If I draw, that's a horrible line. There we go. Let's make it so we can actually see it. There we go. So I'm putting this horizontal line right at 470. And you can see the resistance in December and January. We can see how we've broken above it. That's the kind of line I would consider a pivot point, right? We have one on the S&P around 50-50. I think this is that same kind of level. And as long as we hold 470, this is a really good chart. We break 470, even worse, we break the 50-day moving average. That's where I would start to think, all right, there's a much greater opportunity or greater probability that we break to new lows. So generally speaking, this type of chart is the kind of thing I would think is bullish until proven otherwise. So taking a position here using 470 or maybe the 50-day at 464 as a stop, or getting a little more complicated using something like the chandelier exit, which we'll refer to in a later question. Using something like that, I think, is a decent approach. When I'm scanning for stocks making new highs recently, I'm finding a lot of Gartner Groups and Mettler Toledo's MTD and a lot of other names out there in industrials and financials and basic materials, even consumer staples, even some food products names, and others that are making new 3-month highs. So I'm not struggling to find stocks that are breaking out. And I think buying those types of breakouts, generally speaking, that's a tried and true approach. Using stop losses and using ways of managing that downside risk if the breakout does not play out, I think generally speaking, that's a good way to approach a chart like IT. So I think IT is a bullish chart with a nice breakout until proven otherwise. And I would have that level defined, and I would set an alert what would need to happen on this chart for you to not be constructive anymore. Think about what that might be. For me, it's 464, the 50-day moving average. That would be the first starting point. 470 would be an initial stop, as I would see it, using the charts there. Thanks for asking about Gartner Group. I think a lot of charts like this, just breaking out are encouraging. Next question, could there be an argument we are in a seasonal pattern this week with the low volumes? And I appreciate you asking about some of the seasonality here. Just to catch you up here, I mean, this has been, to be honest with you, a bit of an unusual beginning to the year, right? If I'm looking at the last 20 years, and we'll take this year out of the scenario. So I'm looking at just the seasonality chart, and the way you get to that, by the way, is click on Sharp Charts up here at the top of our site, where you would type a ticker and switch it to seasonality. And then you can click and drag back to up to 20 years of data. So I'm maxing it out at 20 years. I'm starting with 2023 going back to 2004. And if you look, January actually is about a 50-50 shot on the S&P. Half of the Januaries going back for the last 20 years have been bullish, about half have been bearish, and the average return is almost a zero. February actually has an average return of 0.2%. Now, January and February in 2024 have been remarkably strong. Now, March and April actually tend to be pretty strong months for the S&P 500. But if you take out all the non-election years and just leave the election years, so I'm leaving 2004, 2008, 12, 16, and 20, and I'm just deselecting all the other non-election years, now you'll note that in an election year, the first quarter actually tends to be pretty rough. So January, February, March, on average, excluding this current year, have an average return of about -1%, and more often than not, it's down rather than up. Now, this Q1 has been very unusual for an election year. Most election years have a pretty significant low in March. We're running out of March here, right? We're in the last week of March, and we got a holiday week, which is usually a little lighter volume. So I would say the seasonal tendencies, which have been spot on for the last 18 to 24 months, not following the playbook particularly well, only that Q1 tends to be weaker. Q2 actually tends to be quite strong. If you look at the average returns, April, May, June are usually up, and April is actually statistically the strongest month out of the last 5 election years going back to 2004. So I'm not sure how much I'm going to buy into that particular idea, but playbook would say low in March and then a strong April. So that's what's in the back of my mind. The trends have been the opposite. The trends have been quite strong. Now, you asked about the low volume. I would say the volume on the S&P this week is less about seasonality and more just about a lack of catalyst and the fact that we're in a shortened holiday week. So Friday is closed session for bonds and for stocks. I don't have the volume on here on the chart. Let me add it on here very quick. And what you will find is that the volume has been a little bit lighter, and I think that's just the nature of the fact that we're in a holiday week. So volume's usually a little drier. Probably see a pickup in volume next week. We do have some economic data. So these big spikes are like Fed meeting days. So this is the Fed meeting day recently where we had the big influx of volume. A big economic release could do it. We do have some economic data through the course of this week, but I would expect lighter volume just based on the seasonality of the holiday week. The week after, I would expect an increase in volume yet again. And let's see what happens in April, which is seasonally one of the stronger months of the 12. Next question, would you please elaborate on the practical use of ATR, which is average true range, in the setting of trailing stops, that is, not stocks? Really good question, by the way, and I appreciate you asking about average true range. I've mentioned a number of times that, when I think about trailing stops, I think you can start very simple. And my first answer would be, if you don't have a trailing stop of some sort, start there. Start with something. And even if it's like a brutally simple approach, like the 50-day moving average, or 8% off the recent high, or something like that, at least that's something. And I would say have something, right? Don't have nothing. Then we can start to improve on how do we make that more and more optimal. The problem with using something like a percent stop, right, which would mean if we go 8% below a recent high, then I want to close out. So if you look at something like IBM, we can do that by looking at the percent change tool, take a recent high, and then go down about 8%. So that gives us a low, that would give us a stop right around 185. And so saying, all right, 8% below the high, I want to sell. This is a classic William O'Neill approach where he just had a percent off of the recent high. That's your stop. And what's good about that is you are limiting your downside to 8% off of the high. And so you are not going to have an 80% loss because you're selling at 8%. But it's not ideal, right? Because a utility stock or a biotech stock are going to have two very different percentage moves on an average day and an average week. So the chances of us hitting that stop are actually very different. So we can use an indicator called average true range. We can actually chart the average true range as a standalone indicator by adding it as an indicator below the chart. You'll see what the chart looks like here. And here we're actually showing in dollar terms the average true range. The average true range, or ATR, basically is the range that the stock trades in. So the range is the high to low, and true range means you just adjust for gaps. So if there's a gap, you take that gap into consideration when you're calculating the high to low range. And 14 means you're looking at the last 14 days. On average, what's the range of this stock adjusted for gaps? That's what the ATR is actually telling you. But what does that mean to be $3.21? How do I actually use that as a stop? Good news for you is we actually have an indicator that does this called chandelier exits. And there are two parameters that you see here, 22 and 3.0. What this is basically doing is I want to use the average true range. I want to take the 22-day high, and I want to do 3 ATRs away from the high. So what that basically means is, if you put it on the chart, is this is showing you 3 ATRs from the most recent high using the last 22 days, and using the last 22 days to calculate the ATR. That's three ranges off of the high to calculate your stop. And so it is very much dynamic because it's based on the average true range. So a stock that is more volatile is going to have a wider stop. It also allows you to customize it. So if you want to say 2 average true ranges, you can change the setting to 2, and you will see that it's a much tighter stop because it's just double the ATR. The default setting that we have that was created, I think by Chuck LeBeau was the one that popularized this, which again is just a way of standardizing the use of average true range, is to use the 22-day high and use a 3 ATR. If you want to learn more about that, we have an article about the chandelier exits. Dr. Alexander Elder in his books talks about the chandelier exit as a good trailing stop system. And if you want to use average true range, that's where I would do it. Read the article and you can get more information about exactly how it's creating those lines and how you can use it on the short side as well if you play the downside potential in stocks. Next question, where would you place Fibonacci retracements on NVIDIA? Thanks for the simple question, and I will try to give you a straightforward answer. I often get questions about where to place Fibonacci retracements. You have to remember that certain indicators like the chandelier exit or RSI or MACD or moving averages are not subjective, right? These are objective indicators. You can change the settings for sure, but once you come up with the 200-day moving average, it's pretty much what it is, right? There's no tweaking that average. But things like trend lines and Fibonacci retracements are more subjective because you actually have to define what levels you're using, right? So when you draw a trend line, you have to pick the low prices or the high prices that you're using. And so we might have different levels that we're using because we draw different points. So how would we use Fibonacci retracements? So my first question to you would be, what time frame are you thinking about? Because when you think about what levels to use, it's the most significant highs and lows for the time frame that you're considering is how I would generally describe it. So for a lot of people looking at NVIDIA, I would say there's been a big move off the October 22 low. There was this rally into the summer of 23. Then there was this big sideways period, and we bottomed out right around $400 a share, and then eventually broke above 500, and that got us to a test of just below 1,000 earlier in the month of March 2024. So I would say, what are the most significant highs and lows on this period? Well, I would say you have 2 different answers, right? So you have the sort of longer term, whoops, it's under here. We have this big long-term thing, and I'm making them very bold just so you can see them, but here I'm taking the October 22 low and then saying the top out around 974. There's my first downside objective to this big long move. Now the problem is that's an objective about 350 points, around 35% below that all-time high. So I would say for most of us, we probably want to look at a little shorter time frame. So I'm going to look at the last year. Here I can see that low from October of last year, which I think is a pretty important one. So I'm going to redraw these levels and take it from that low and take it from that high. What I'm basically doing when I draw these Fibonacci retracements, by the way, is say this was the beginning of the move, or at least the low of that basing pattern. Here's the peak around 974. If we would pull back within that range, which we may be doing here this week, what's my first downside objective? 752 is the 38.2% retracement. And what I love about this is it lines up almost perfectly with the 50-day moving average. So a downside move here would say 38.2% of the way down, gets you right to the 50-day moving average around 750 to 760, we'll call it, depending on how quickly it would come down. That's where the 50-day moving average would be. So what I'm doing is I'm defining the low and the high that are important for the time frame that I'm operating on. You could use a weekly chart and look at very long-term Fibonacci levels based on that framework, but you have to remember that might take months, if not years, to get down to those levels. So if you're a swing trader, maybe you want to zoom in and take shorter-term levels and just use these short-term swings. You really can do it across time frames, but for me, I often bring up the chart. What are the most significant highs and lows? Those are the levels that jump out to me when I'm looking at the chart. So that's what I would use. And again, it gives me an objective around 750, 760 for NVIDIA if we would get further deterioration from what we've seen so far. Final question here for our Oral Mailbag episode. What do you do with a stock like GLP that has a high dividend yield and a strong price trend? Really interesting question. And GLP is a stock which I was not super familiar with, so I had to look into it a little bit. And there are a lot of energy stocks that I don't know There are a lot of stocks I don't know, to be honest with you, but when you get down into the energy, sort of smaller names, this is a $1.5 billion market cap. So, it's really a small mid-cap name. I don't know all of these. And so this is, I appreciate the question about this one, so I could look into it. It is an E&P stock, and we do talk about exploration and production names on the show for sure, but this is one that's a little lesser known. So what do you do with a name like this that has a pretty good run? If you look at the weekly chart, you'll find that, this is a stock that looks, honestly, I wouldn't be surprised if this was a technology name, just in terms of the trajectory off of the March 2020 COVID low, and just the fact that it really hasn't had significant drawdowns at all. I mean, these pullbacks that have happened, but overall, look at how the consistency of the trend on the weekly chart that has gone higher. So what do you do with a name that if you bought it back here, it's probably become a bigger and bigger part of your portfolio? The dividend yield is still around 6%, but back here was probably a much higher yield. I don't know the history of when they've tweaked their dividend, so I don't want to assume that, but assuming they had a consistent dividend, when it's trading at $10 a share versus $45 a share, the dividend yield is much higher when you're down here, but it's still a pretty good yield at 6%, trading at $45 a share. So what do you do? This, so starting off by saying with portfolio construction, this really gets a little bit into an area where I would encourage you to talk to a financial professional, really do your own work about due diligence, about how you want to think about position sizing and the tax implications of buying and selling at different times. That's outside the scope of what we want to talk about here on the final bar. But I would say from a technical perspective, sort of money management perspective, really, when something gets bigger and bigger, you have a couple things to think about. Number one, remember that as it grows, it becomes a bigger and bigger portion of your portfolio. And so there's a thing called a rebalance, which is something I would look into, which is as something becomes more and more successful, it becomes a bigger and bigger weight, you sell a portion of that, which brings it down to a target weight. So when you think about a 60-40 split in a portfolio, 60% equities, 40% bonds, you have to often rebalance that once a month, once a quarter, at the least once a year to bring it back to those target percentages. And that's how you don't get a very overweight portfolio that's all in on equities if that's an unintended bet that you don't want to make. So think about scaling out of a position as it really accelerates to the upside because it's just becoming too big of a position for you. The other thing is to use more technical disciplines, right? So if you get signs of a pullback, I can't help but notice that the weekly chart was overbought in December and it's now coming out of that overbought range. The weekly MACD is given a sell signal here in March for the first time, really since back here in February, March of 2023. So maybe that's an excuse to lighten up because I'm starting to see signs of price deterioration. So, step one, I guess choice number one is to rebalance just based on the size and get it back to a target percentage. Question two would be use a technical signal as an opportunity to scale back. And when the chart is looking strong, you stick with it. When it stops looking strong, that's when you start to sell some of the initial position. Again, those are generalities. I think you really want to talk to someone about your particular situation with your portfolio and make sure you do your due diligence. But that's how I would think about the size of a bet and how it can really get bigger and bigger. But a good dividend yield in that name and a sector where you're seeing certainly some resurgence as crude oil prices have gotten above $80 a barrel. That is it for our special Good Friday edition of the Final Bar in our mailbag. Have a fantastic long holiday weekend. We'll be back hopefully with a normal show schedule next week, and we'll look forward to recapping the market with some great guests all next week. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good weekend.